Etsy is an interesting growth stock to consider. The company employs one of my favorite business models right now, and that's the platform business model that brings together two sides of an equation and takes a profit from every transaction on the platform. Other companies that operate this kind of platform model, like eBay, Uber, Airbnb, etc., are delivering strong profit and cash flow expansions. And so you can understand why I'm attracted to this kind of business model. But what's a fair price to pay for Etsy stock? That's what I'll answer in this video, doing a discounted cash flow valuation of Etsy to come to a conclusion of what a fair price per share is for this growth business. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so let's look at my discounted cash flow spreadsheet here. The section in green shows the free cash flows forecasted over the next decade and longer term. And then the section in blue talks about the discount rate, the weighted average cost of capital, the cost of equity, and the target capital structure. And then the section in red adds the company's cash balance and subtracts the debt to the value of operations, and then looks at how many shares are outstanding to come to a value per share for Etsy's business. So let's get started with the section in green. The analysts on Wall Street that are following Etsy stock, they expect the company's free cash flow to rise from $680 million in 2024 up to $840 million in 2028. So it's not like right now the analysts on Wall Street are very optimistic about Etsy's business. They only expect the company to increase its free cash flow by $160 million in 4 years. That's not very much for a growth business. From 2028 to 2034, I've incorporated my own forecasts, and I haven't forecast a strong growth rate for Etsy either. I'm only forecasting the company's free cash flow to grow from $840 million to $1.2 billion. So again, not very much increase here for Etsy's free cash flow over these next several years. And the reason for that is that the company is not attracting very many new customers. It's not attracting very many new customers. Now, it's getting more revenue, more profit from each customer, but new customer growth has been more difficult for Etsy. Remember, the company's business boomed during the pandemic, and one of the most popular things to do was to buy or sell masks during the COVID pandemic on Etsy's platform. Remember when we all had to wear masks and people were buying specially designed masks on Etsy, and that created a boom for the company's business. And so now in the aftermath of that boom, it's losing some of those customers it gained during the pandemic, and it's having trouble replacing them with new customers as people are flocking to other websites like Amazon for their online shopping needs, or lower priced businesses like Temu or AliExpress in other areas. So growth in new customers is difficult for Etsy to achieve. So when I take the present value of all of the free cash flow Etsy is expected to earn in its lifetime, that comes to $9 billion, the present value. And the reason we need to take the present value for future cash flows is because money in the future is worth less to us than money today. The discount rate I applied for Etsy, or the discount rate I should say that I calculated for Etsy, is 13.46%. I've applied a cost of debt of 7.5%, a cost of equity of 16.44%. I employed the capital asset pricing model to get the cost of equity. The stock's beta is relatively high at 1.99. The risk-free rate is 4.5%. The market risk premium I used is 6%. Etsy's market cap as of the date of this model, when this model was created on February 1st, was $6.2 billion, and the total debt was $2.4 billion. And so I've given them a target capital structure of 33% debt and 67% equity. And that's how I arrived at the weighted average cost of capital of 13.46%. Remember, weighted average cost of capital takes the cost of debt multiplied by the percentage of debt plus the cost of equity multiplied by the percentage of equity. That's how I compute the weighted average cost of capital. So now that we've done those steps, we can go to the value of operations again, which we calculated earlier at $9 billion. We add the company's cash and subtract the debt. We get the value of equity of $7.6 billion. But we want to know the price per share, so we divide by the number of shares outstanding of 130 million. And that brings us to an intrinsic value per share of $58. The current market price is $53.30. So depending on the margin of safety here, I typically like to use a margin of safety of 5 to 10%. We can go ahead and say that Etsy stock is undervalued. And this is especially the case when you consider that the beta is 1.99. So if there were to be adjustments to the beta, which I'm not doing here, but some analysts that are following the company or you yourself might want to adjust this beta downward. And if you adjust the beta downward, that will create a higher intrinsic value per share, because you may or may not believe that the company's share price deserves a beta of 2 going forward. Because this beta is a historical beta that measures the company's stock price movement compared to the movement of the S&P 500 index. So a beta of 2 signifies that Etsy's stock price moves about twice the rate of the S&P 500 movement. So if the S&P 500 moves up by 1%, Etsy's stock price moves up by 2%, and vice versa on the downside. And so that means the stock price is more volatile than the S&P 500 index, twice as volatile as the S&P 500 index. And that's a measurement of risk, right? When your valuation is moving a lot more than an index is, that makes it more volatile, and volatility is a measurement of risk for investors. So you may or may not want to adjust that beta downward, and that will give you a higher intrinsic value per share. For my base case here, I'm keeping Etsy's beta at 1.99, but I wouldn't be surprised, let's say 3 months from now, 6 months from now, if this beta moves lower, or if I do this evaluation again and I see that Etsy's business is in a different range now, the stock price is in a different category in terms of volatility, I wouldn't be surprised if I update that one lower. So the trend is lower for Etsy's beta. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.